And I love that I'm going to be the first to then acknowledge that I'm very ignorant on this. So it will help our general public, who I feel are hopefully just as ignorant as I am on it. To where then, so let's talk about when you're talking about, like, if you have a line, like you, and I'd heard you reference this before, of like having a reverse mortgage equity line, then, so how does that work differently than a traditional equity line?
So, well, the big difference is on a reverse mortgage, you're not having to make a payment.
Yeah.
So, but ultimately, it's a line of credit. And we just call it a home equity conversion mortgage instead. But it's a line of credit. You can choose to take monthly draws on it. You can choose to set up a draw amount for as long as you live in your home.
Okay.
That's actually two different options. The numbers come together differently in that, and I can go into more detail. But, or I have some people that just have a line of credit established. I have an elderly couple where, unfortunately, the gentleman has some illnesses and he doesn't know how much longer he'll be in this world, and he's worried about leaving his wife with just one Social Security, and they don't really have a pension plan or retirement. So she'll take distributions later, but she'll have that line of credit sitting there, and the line of credit actually grows by the interest rate each year, the unused portion of your line of credit. So for simple math, if you have a $100,000 line of credit sitting there, and let's say your interest is 6%, in the first year, your line of credit is going to be $106,000. And then the following year, it's going to be 112, but it's going to accumulate over time.
Okay.
So,
and again, go with me on my ignorance. So if those, I'm going to quit using the word I'd assume. So if are you seeing kind of both the people doing large one-time distributions, or is it more so just of like kind of cost of living monthly distributions?
Well, everyone has individual needs, but mostly what I see is people paying off their current mortgage. Just by eliminating their mortgage, that makes their retirement dollars stretch further. So if they don't have to make a mortgage payment of $2,000 a month, that's $2,000 less that they need to pull from their retirement account to help.
Yeah. Okay.
So mostly that's what I see. And then any remaining line of credit is just a bonus for people that they can utilize later. I have one client that will be purchasing a car in a few years.
Yeah. Well, and good to, and just to be able to have additional financial tools on that end. So then in my vein of ignorance, to where, the bank's not doing this for free, right? Mm-hmm. And so once let's go with that example. Okay, $100,000. Let's say they have $100,000 mortgage, and they pay that off with let's start simple for my brain, $100,000 reverse. So now they do not have to make any payments, and with that equity line being at 6%, now does that capitalize annually to where they owe 106? The next year?
So whatever their balance is, just like any other loan, it's basically, you could say, simple interest. It's going to accrue interest.
Yep. So just accrues interest year over year.
Yes.
And now, to the extent, I'm sure there's pretty complex calculations then, and then based on how old they are and how much equity is in the home, how much they'll be able to get out, because the idea is not that all of a sudden they'd be underwater on it, right?
Right. Yes, and that's part of what FHA has done to make the program sustainable. Okay. They only allow you to tap into so much equity. So if you're 62, maybe you're only tapping into 45 to 50% of the equity in the home.
Okay.
Because it allows for that line of credit growth. And let's say if you are 62 and you live to be 100 years old, think about that, the amount of time that you're in that reverse mortgage. And some people want to stay in their home until they're no longer on this earth, right? So that makes the program sustainable by only enabling borrowers to access that much equity in the very beginning.
Gotcha.
So the older you are, the more equity you can tap into.
Okay. So you have to be a minimum of 62, right?
Yes.
And so let's go with that what if scenario. I'm sure people ask you, what if I live forever? So is the interest able to just continue to capitalize, or does that cap off at a certain point, or what happens?
So
am I using the right term in saying capitalize it? Yeah, just adding to it. Yeah,
a couple different things there. If we're talking about the interest that you're paying, yes, that's going to continue to accrue. Some people, depending on their situation, will pay just interest payments. You can make payments on these loans if you choose to. Okay. So I have one client that will pay the monthly interest just so her balance doesn't grow, and the interest is so low, she's able to manage that.
Sure.
I have other clients that aren't worried about it at all, whether they have children or whatever their situation is. They're needing to take care of their needs, and they're recognizing that they want to take care of themselves or take care of a spouse. So they're not too worried about the balance as it grows. Yeah. Although it is by not tapping into all the equity in the very beginning, when you run the numbers. Generally speaking, so just as an example, if I look at an amortization schedule and I look 10 years from now, we take into account the appreciation of the property. A conservative appreciation annually of about 4% is what FHA uses. I would say that's very conservative when you look at what we've seen in the last decade. But when you look at those calculations, factoring that in, what a borrower's initial balance is when we close on the loan, and what their balance is in the future, but also what we take it another step, we look at what the property value is, and with that appreciation and what their initial balance was and what their future balance is, they end up with more equity when they sell their home.